But joining us here to discuss recent developments in global financial markets and trends in emerging markets, because he's got some interesting views, is Anthony Ginsberg from Ginsglobal Index Funds. Anthony, I was mentioning in the intro, you're a South African,
yes.
Or a relocated South African who now lives in California.
I'm always happy to come back, Alec. Every time I come back, there's always a lot of news in South Africa. The perception abroad right now has not been the most positive on South Africa as I've seen it over the previous 4 or 5 years. So I wish I was coming back with better news about foreign investors wanting to buy into the local market, but there's a lot of uncertainty. I think the mining and the foreign direct investment regulations are really causing some uncertainty, unfortunately. You know,
we're so small in a global context. I did some numbers the other day which showed that if we were a state of the United States, we'd come in number 17 behind Indiana. In fact, 1/7 the size of where you live in California.
Well, scary enough, California on its own is either the 6th or the 7th largest economy in the world. Almost half of our business today is actually conducted in California. We're very big in the index fund business overseas. And South Africa, unfortunately, has a risk. If we get downgraded in South Africa with our bond ratings by S&P on the sovereign ratings by just another level down, South Africa has a risk of potentially having further assets sucked out of here, because currently South Africa is part of the global government bond index. So we've got to be rather careful that with FDI and other rules here in your current account and other twin deficit issues, that these things have to remain in whack. Otherwise, a lot of foreigners are worried that with another possible downgrading, there's going to be further flows out. So I get a little bit worried about the currency issue, particularly given your 6% or so current account to GDP deficit.
So it is fragile 5. We know all about it in this country. But the business that you run is index trackers, both in developed and developing markets.
Yes, partly because of 2000's meltdown in 2008, there's been a massive demand for more transparent rather than black box products. So you find in the States today 50% of all mutual fund flows are into ETFs or into index funds. And our big clients such as AIG and Zurich Life Insurance and ING Insurance are using indexing now within insurance policies, within annuities, within life insurance policies, within all kinds of long-term retirement savings, RAs for instance. So indexing has become a predominant means now for retail. It used to be mostly institutional players like CalPERS of the world using indexing. Today, about 1/3 of all mutual fund assets, as they're studying them, are now also going to be essentially in index products. 38% of all pension fund assets in the States are in one way or another in passive products today. So it's quite a big trend going on globally.
And you know the South African scene. I mean, you grew up here, you have family here.
Yes.
Why do you think it's taken this country so long to click to the fact that index funds are pretty good investments for know-nothing investors?
That's a very good question. You always ask perceptive questions. So I think the answer is that IFAs in America, financial advisors, earned their fees today based on a fee. So they want the lowest cost building blocks, whether it's the unit trust using indexing or even an active fund, but they want the cheapest building blocks. In South Africa, you still got a commission situation where people are getting paid in a different format. So, but in the UK and in the US, increasingly, guys are looking for the lowest cost asset allocation building blocks. So if they want exposure to mining or to small caps or to emerging markets, they'll use indexing rather than finding some hotshot manager who more often than not is a comet that flames out after a couple of years. The trend increasingly is somebody who's on the front cover of some of these famous magazines. He's already had his day in the sun, and he's not going to be necessarily a star going forward, but rather a comet. So you're finding the guys are remunerated overseas in a different way. The RDR review in the UK, as you know, and the IFAs in America are typically getting paid now more for asset allocation advice and risk management advice. They're not being picked or being chosen based on hot tips or on who they think the next star manager is going to be. So they see their financial advisory job changing, being more risk orientated, giving a full service based on the family's current accounts that are required, and also estate planning.
And the population happy to pay fees? I think that's been the case in South Africa. I remember years being drummed into my head that insurance policies or investment or savings products are never bought, they're always sold. Now, if you're charging a fee, it's pretty hard to sell something, whereas if you get a commission from the insurance company or the asset manager, it's a lot easier.
Well, the regulators have really slammed down on kickbacks and rebates and under-the-table commissions. So increasingly, clients are actually seeing all the fees now. And if they'd rather pay 0.2% on an index fund than maybe 1.4% on an active fund, just give a sense of this. If the industry feels that the American market will grow 7 to 8% a year over the next decade, a 1.4% fee is almost annually about a 20% performance fee you're paying essentially on that return, whereas a an index fund fee of 0.2 or 0.3 works out to be about a 3% essential fee.
What do you guys charge on your index?
We're between 20 to 40 basis points.
So you with Signia who've come
No, we're not actually with
chase, no, but they've come to change the market, they feel, in South Africa with their ETFs. Yes. I think they're at 0.3 as well.
Right. We work with Satrix and some of the other big boys, Old Mutual, Sanlam and folks like that. And for us, we're really trying to bring the fees as cheap as we can. So in fact, our offshore index fund fees at 20 to 30 basis points. We actually have a 15 basis point global bond fee, for instance. Some of our global equity index fund fees are also around 15 to 20 basis points. We typically have a retail share class and an institutional share class. And our fees are significantly under some of the index fees offered in South Africa. I think, unfortunately, the administration fees here, historically, you're right, were quite high. Administratively, in the States, they're even using index funds as loss leaders now. So the Schwabs of the world and the Fidelities are trying to get people onto their platforms, offering iShares and other Vanguard and index funds like ourselves incredibly cheaply, because they know that there are other products that could be wrapped where they can charge slightly higher fees. So indexing is seen as the cheapest and, frankly, the most transparent way of getting global exposure.
Anthony, we spoke earlier off air about California, where you live, being the bellwether for the United States, and of course what happens in the United States happens elsewhere in the world as well.
Yes.
You've got a good feel for the way the developed and the developing markets are going. And interesting reading your latest research report. Do you think that emerging markets are now starting to offer value again?
Yes. Well, obviously the trend, everybody says, is to get out of Russia, for instance, but Russia's trading at PEs of about 4 and 5. Emerging markets, based on the MSCI, are trading at price to book below 1, and the MSCI is
Explain what that means, price to book below 1.
Well, based on a net asset value of a company, you would think if it's got good prospects, typically banks and others may be trading at 1.5, even 2 times their book value based on their balance sheet. These things are trading sometimes in the MSCI emerging markets at 0.7 to 0.8.
So they're paying you to buy those. In fact, you're buying it at today's price, you're getting it at a big discount.
It's a real Warren Buffett style value investor. So yes, I know that it's totally out of favor, emerging markets, but the truth is that they've gone nowhere in 2.5 years. There's been about a 40% gap between how the S&P 500 has done and even Eurostoxx relative to the MSCI emerging markets. So if you said, where's value for money based on PE ratios, just simplistically, you've got PEs of 17 and 18 in the US, it's quite high. Europe's about 20% less on the PEs, arguably, but the emerging markets are a steal, you could argue, at about 9 to 10 on the PE.
What countries?
Okay, so we like Korea, we like parts of Latin America, meaning Chile, Peru, Colombia. They've done very, very well. And when you look at Europe, obviously Eastern European countries like the Czech Republic and Poland are very, very attractive, frankly, right now.
So would you then be sitting in California buying some of those markets in the same way as you would buy, say, Satrix in South Africa?
Right, so you can overweight Poland versus the UK. So when we talk about Europe, we don't necessarily just stick to one particular index. So you can customize these indices. And there's an emerging European index, for instance, where you'll get the Eastern European countries. For us, our biggest bets for our clients, typically in South Africa, who I go and see every 9 months, they're looking at global developed markets versus the emerging markets. And right now, the belief is Europe has underperformed, as have emerging markets relative to the US. The US has really run. I mean, my property in the US, real estate prices have come back in California. California is relatively healthy. Unemployment numbers are at about a 5-year low now, both in the US, about 6.7%, and also California numbers. So if you actually look at the trend, the US has had a very, very good run. We don't believe that the bull market's over by any means, because dividend yields, Alec, you'll know from what your experience, versus bond yields, typically bond yields start getting pretty frothy at a certain point. And we haven't seen bond yields go anywhere. Right now, the federal 10-year Treasury is sitting at just over 2% still.
You know who was in town last week was Ben Bernanke, one of his very first, I don't know if it was the first, but it was certainly one of the first public appearances. And he came across so well, despite the fact that he's now out of office. He gave one a lot of confidence that this American upswing is real, that in fact they've pulled it off. Do you agree?
Yes, and believe it or not, manufacturing is even coming back to the US because of some of the wobbles in China and some of the issues with transportation costs. America's, as you know, about the shale gas, all our manufacturing costs are starting to come down in America. Energy prices in America are far cheaper than in Europe. And increasingly, the unemployment numbers look very, very attractive. America's not completely out of the woods for new job hires, but for people who are savers, There's been a wealth effect the last 4 or 5 years. We've had a tremendous run up. We're over 100% gains. I mean, the S&P was at 667. Now we're at over 1800. So there's a lot more optimism in America. People know we're not completely out of the woods, but the yields have been low, and Federal Reserve Chairman Yellen will most likely keep yields at very, very low. This tapering is going to take a good year to still work its way through with the $10 billion a month tapering. So
the confidence is well founded.
And I think Europe is still undervalued in terms of the equity market. So we see our clients trying to be a bit slightly more overweight now in European equities and in emerging markets.